Hey, welcome to the podcast, everybody. Thanks for joining me here today. Hope you had a great holiday weekend, and certainly looked like yesterday the Bulls were back in charge, although it was low volume, didn't really have the intensity that we would want, but nevertheless, given that we were oversold enough, we did get a rally on really not much news or anything out, but come back today, and of course you can see from the screen everything's pretty much red, and starting with the Dow Jones down 160 points, 1.3%. S&P 500 down almost 20 to 1313, down 1.43%. Mid caps, small caps down 2%. Semiconductors down 2%. Transports down even worse, 2.12%. Financials down 2.3%, and you can see oil and equipment and services stocks down 4% as commodities continue to get hit hard. Of course, oil prices really down a lot. And treasuries down there at 1.62% for a 10-year treasury. We are now back into, actually not back into, that is a new record low for treasuries made earlier today. So, and of course, you can see the only thing green on the screen is the dollar. And the dollar was stronger once again. For those that are holding cash, not only do you feel good on a day like today when you have cash, but the cash is actually increasing your purchasing power. It's the opposite of what we've talked about the last several years, as the dollar has continued to lose value over the last several years. But whenever there is some type of crisis, short-term concerns, especially on a global scale, money tends to flock into the U.S. dollar and primarily into U.S. treasuries as a surrogate for that. So that's why you're seeing treasury yields go down, prices go up, and the dollar continue to go up. We saw things like utilities hang in there a lot, for most of the day. Some tech actually was doing okay, and then towards the end of the day, you saw utilities even give way, even though on a relative basis they held up much better. Pharmaceuticals and healthcare held up pretty well today, but overall it's still a very, very negative day. So let's start out looking at the S&P 500. Of course, I continue to leave this up as kind of our breakdown area. And the stock market, being oversold, as we know, did have a rally. We had a pretty good day back on the 21st. And then kind of a sideways, kind of volatile days, but pretty much up. And then we had, of course, a big day yesterday. Today gave it all back and then some. And on top of that, the concern is obviously not only did we drop, but the volume was stronger than the day before. So we're getting intense selling on the way down and not as intense buying on the way up. But overall, I think when you look at this, I've drawn these lines because we're still in this kind of up channel, even given today. And on a day like today, it does make the bulls say, man, I guess yesterday was really just an anomaly. And it probably was, given the fact that today was much more of an intense down day than yesterday was an intense up day. And that's what we have to do. Is when we have back-to-back days of really good versus really bad, you have to compare them. And what we know today is that we saw a 90% plus downside day today. That's the stocks, 90% of the stocks going down, 90% of the volume, downside volume was greater than 90%. And we saw the volume increase on a down day today. So those are things that obviously say, hey, it's not the selling isn't over just yet. So we had the bounce, didn't go as high as I thought it would, and perhaps those holding long positions. But I didn't load the boat down at the lower end either. I covered a short, bought a couple of positions for trades, but for the most part, I've pretty much kept my same position as we've gone down and then back up here. I haven't really changed my position overall because of the whipsaw nature of the market. I think you can get whipsawed very easily. In fact, if you look at what happened this day, very volatile day. This day, very volatile day. Of course, yesterday up strongly, today down strongly. So those are all, the volatility is obviously picking up, but I would have assumed that we would have bounced a little bit more than we did. And again, the reason I'm drawing these lines is because perhaps this is still intact and we do work our way a little higher. And remember, these moving averages are going to continue to roll over. The 100-day is going to continue to get weaker by nature. That's because of the fact that the way the numbers work out. This was moving up, then it started moving here, and it could start to roll over as the more of this gets priced in there. And this could work its way up to that before we get a bigger a bigger downdraft. So again, don't overdo things here, but the point is now we're not as oversold as we were back down here. Here we were extremely oversold. We saw a lot of extreme conditions that caused me to cover a short position, and we've got that bounce. But now we're not as oversold as we were then, so that leaves potentially more room to the downside. And one thing to remember, after a day like today where you have a 90% down day, it's extremely common to have a few days of an up market. And whether it's a temporary bounce, it could be just a couple of days, or it could be a week. But generally speaking, after a 90% down day, you do get a bounce after that. So again, if you're wanting to short tomorrow morning, barring any really negative news, I would wait to short into a little bit higher prices. That's what happens after a 90% down day. Watch that over the next few days here. So one of the things we were watching today, obviously, was interest rates. Interest rates continue to fall. Money continues to pour into treasuries, and TLT is the place for that. And there's been a lot of people short treasuries thinking that it just can't go much lower. And look, you got a Fed that is a natural buyer, keeping a lid on those rates. And on top of that, you have obviously money flocking to the dollar, which is going into treasuries. And then thirdly, you have a weak economy, which is justifying lower rates. So you put all that together, TLT is doing well. I wouldn't buy it right here. I think for the first time I'm seeing some negative divergences just that were created today, meaning from the time that we've had the jump up in prices here from, let's call it May 17th until today, about a week ago, you're starting to see some negative divergences. So, but here's the thing that the bulls have going for them. First of all, we broke through this little downtrend that was provided here, top here, and at top here. We broke through it. Then the next thing was it kind of paused out at, and let me get rid of this one line, but it kind of paused out at potentially making this double top here. And then the bears were saying, yep, it's not going to be able to break through. So that was a logical place to short. But we come in today and it broke through that upper line, and not only did it do it, but unlike the stock market, which has had weak volume on buys, look at the volume on TLT today. That's the highest volume we've seen since going back to March, and that was a down day. So we had some very strong volume today of people jumping in treasuries. I wouldn't buy it right now. Like I said, I own some things that benefit from falling rates, and that's great, and I'm enjoying that, but I'm not going to run out and buy treasuries right now. On the other hand, I would not be shorting treasuries either because of the fact of all the three things I just mentioned. So we could get a reversion to the mean trade where we perhaps see it come down to the 20-day moving average, but for the most part, to see a change right now, I don't think we really see one. But certainly when you see the type of volume that we're seeing today, you get 2 or 3 days like that where it's really high volume, then you can start looking for the opposite to happen and start seeing a move, a counter trend move. Another sector that looked pretty good for a bounce was financials, and you can see it came off of the 200-day moving average, which it broke through here, and then it finally bounced off of it there, and that looked like a good support. If you're long financials, this is the place for your stop, right underneath the 200-day moving average. That's just a logical place, and it may hold. Just like the stock market, it may work its way higher just because we got one down day, but overall, you have to be careful of financials in general because they're right in the middle of not only the J.P. Morgan issue, we'll call it, but on top of that, the overall situation in Europe. So be careful with financials. If you're long financials, then obviously the 200-day moving average is your stop. Here's semiconductors. This is kind of a little different picture because we're below the 200-day moving average, and it looks like it's kind of trapped below it. So you have to watch out with semiconductors. Wouldn't be touching those either right now. Here's kind of the trend we've been in. So again, we could work our way up to the top of this, which again would be probably around the 200-day moving average and then fail. But overall, didn't quite get up there. So that's an area to avoid as well. So I am long Apple, and I mentioned that the other day. I got long about 6 days ago or so. That was a day it kind of looked like it was turning around. It bounced off the 100-day moving average. I bought into it. It continued up the rest of the day. I think I'm long at 546 or so. And then it ran into this downtrend line, had a little trouble, and broke through it today, and actually was up in obviously a weak tape up 1.2%. So not a bad move, $7 to Apple, and it's breaking out here. So not bad. There's still some negative news coming out about Apple and some of the weakness in some of the downloads from the apps over the iPhone. But remember, we're coming into what's going to be, I think, a pretty good another product cycle for them, what people are going to get excited about. And it's a few months off, but I think overall, again, what you want to look for is stocks that are outperforming the market in this tape. And Apple was open lower and then finished stronger throughout the day and ended up 1.2%. So still like Apple, not suggesting it for a trade. I'm just disclosing that I own it, not recommending you buy it, of course. And last but not least, Facebook. FB had another down day today, down 65 cents, 2.2%. And it was actually up on the day while the market was down. This is a 5-minute picture. I'm going back all the way to the IPO day, of course, when it bounced up, couldn't hold it, gap down lower. And so each one of these are days, gap down, couldn't hold it, finished at the low of the day, kind of a flat down the 23rd. Think a slightly up day maybe on the 24th, down on the 25th, down on the 29th, and then again, let me zoom in a little bit here, but it was actually higher on the day, you can see early in the morning, and then gave it all back, and again, another down day. $28.19 is becoming potentially the worst IPO in American history as far as how this has gone, and it already is the worst how it was done, that's for sure, and now they're disclosing it was complete chaos leading up to the IPO, right after the IPO. It was just a complete mess. And again, I want to reiterate, when you talk about IPOs, all IPOs kind of have to find their way, and you don't know what the right price is. So it's very dangerous to go and buy an IPO. This is not 1995, 6, 7, when you could buy an IPO and buy it even 2 days later and still make a ton of money. These things tend to adjust. They tend to go down until they find their footing, and Facebook will find its footing at some place. But again, with 100 PE, it's obviously not a value stock, and with everything surrounding it in the negative press, not good. But remember, when these guys are on TV celebrating, high-fiving each other, that they have sold their stock to you, that's something to be concerned about, right? If it's so great, why did they sell it to you? I'm not going public. So anyways, I didn't ever own it. Why do I continue to talk about it? I don't know, because everybody else is. But it's very fascinating to see this gigantic IPO completely fall on its face, and Mark Zuckerberg is not in the top richest people in the country, world, whatever anymore because of the obviously decrease in price. $38 a share down to 28. Some people believe it's going into the teens. We'll see. I still wouldn't buy it at this point, and just interesting to watch from the side, and glad I'm not a shareholder. All right, guys, thanks a lot. Appreciate it. Don't forget to check out the podcast, the subscription up at the top right, Google plus Karl Eggerss, Twitter throughout the day, at Karl Eggerss is the handle, and then eggerscapital.com for the money management. Appreciate it. Take care.